Hey everybody, this is Dan Russo, the Chief Market Strategist at Chaikin Analytics, coming to you on StockCharts TV with charting the second half, StockCharts mid-year perspective, and special thank you to StockCharts and the entire team at StockCharts.com for asking me to be part of this project and giving you my thoughts on the market as we move into the second half of 2020 after what was certainly an interesting first half of 2020. And as we kind of close the books on June, I think for a lot of the key themes and relationships in the marketplace, we are standing at an inflection point and at levels where we could break either way and where the implications for investors could be substantial depending on which way we break. As always, if you are interested, you can follow me on Twitter. I am at Dan Russo _CMT. So the charts that I've put together were put together during the day on June 30th, 2020, and I am recording this on July 1st, 2020, and we are stuck in a range as far as the S&P 500 is concerned. For a long time, we have been highlighting key support for our clients on the S&P 500 in the 3,000 to 3,100 area, with resistance in the 3,150 to 3,250 area. And our view has been, as long as support holds, there's likely odds are we are going to attack the February highs, especially if we break through 3,250 to the upside. However, if support gives way, I think we could be quickly looking at a situation where the S&P 500 trades down to 2,850. And if it breaks 2,850, we have to start thinking about this uptrend from the March lows having run its course and start positioning and thinking about what downside situations could look like. Right now, we're in the middle. It's easy to get chopped up. I think as long as support holds, and support is fairly fortified, if you will, as that 3,000 level, has the 200-day moving average, a rising 50-day moving average. It's round number support. So thus far, it has acted well as support. Likewise, 3,150 to the upside, which is the gap from the island reversal that opened with this sell-off here in early June, has also been strong resistance. So when I talk about being at an inflection point where the break one way or the other could have large implications, I would say that the S&P 500 is certainly at one of those inflection points. And what's interesting to me is that if we zoom out and look at the S&P 500 on a weekly basis, and in particular the RSI, what you'll notice at the bottom of the chart is that the RSI, when the market's in a strong uptrend, the RSI never gets oversold, right? Look throughout most of the past 5 years. The RSI never became oversold, and more often than not spent its time above the 40 to 50 area, right? This sell-off actually produced an oversold condition on the weekly RSI for the first time in over 5 years. You can see it inside the box, the little triangle that dips red there for just a moment. And in the subsequent rally, we really haven't seen the RSI go much past 60. So on the weekly time frame, the RSI, in my opinion, is still in a bearish regime. Now, what we would love to see is for the RSI to kind of camp out above the 50 mark and actually become overbought as it breaks through 3,250 and makes a run at those February highs. That would signal from a longer term trend perspective that the uptrend actually has momentum. We're not there yet, but if you look at where the RSI is currently, right around 50, it's certainly at an inflection point. The Qs are still the best game in town, in my opinion, and we can talk about why that is. We'll get to some data points from the cross-asset work that I do that points to why that is. But I think long story short is, in a slow growth world, you want to own what's growing. And the Invesco QQQ Trust is certainly houses a lot of the growth stocks that are out there. So the Qs are recently traded at a new all-time high, very close to striking back at that all-time high again as the second half of the year gets underway. If you look at the bottom of the chart, that's QQQ against the SPY, new relative highs. So solid trends on both an absolute and relative basis lead me to believe that the Qs remain the best game in town and that they are likely to continue to outperform the market. Small caps, on the other hand, are a relative struggle. Now, for a long time, I have not liked small caps, and for the most part, that's been a relative call. In a lot of the work that I've done and a lot of the shows that I host, many of you have probably seen my morning show, 8:45 on StockCharts TV, every day over the course of the past 2+ years. For a lot of that time, I've talked about favoring large caps over small caps, favoring growth over value. And that's largely been the way it's played out, as small caps have underperformed large caps for the better part of the past 2 years. And you can see that COVID accelerated that trend. Look at the bottom of the chart. COVID accelerates the trend to the downside, and then we see a little bit of a stabilization March, April, and May. But IWM is not getting a lot of traction to the upside on a relative basis. On an absolute basis, kind of stuck in the middle with you, right? Stuck between the 50-day moving average and the 200-day moving average. Now, what I would love to see is for the small caps to continue to move higher, because that would be an indication of increasing breadth in the marketplace. But that doesn't necessarily mean that they have to outperform. Small caps outperforming to me would be a sign of increased risk-taking in the market. But you can see at the bottom of the chart, again, looking at the relative, it's at an inflection point. We could go either way here on a relative basis. And I think that will be important, because I think a lot of investors have been positioned in large over small. So if small cap begins to outperform large, there'll be a lot of portfolio shifting that needs to take place. Speaking of breadth, and we'll dig into this a little bit, the median stock in the market, as measured by the value line geometric index, is still in a downtrend. Right, so while the S&P 500, while we're talking about making an attack on the February highs, while the Qs have already attacked and surpassed their February highs, the median stock in the market, the geometric index from value line, in my opinion, is still in a downtrend. My opinion is, if we look at this weekly chart, the index is trading below the 50-week moving average, which is declining, and recently acted as resistance, as did a broken up trend line, the red dotted line on the chart. The index is below the 200-week moving average as well, as it struggles to retake the lows from late 2018, early 2019. So when we talk about narrowness of leadership in the marketplace, you can see it here. From a breadth perspective, the market is still being led higher by the largest of the large caps, right? Your fan mag stocks, Facebook, Amazon, Netflix, Microsoft, Apple, and Google, right? And just look at the bottom of the chart. That's the value line geometric index relative to the S&P 500, clear downtrend, trying to stabilize a little bit, but it looks counter trend in nature. That trend is lower. So breadth remains narrow in the marketplace. Leadership remains narrow in the marketplace, and that's not new. This is ongoing. What's interesting to me is that back in early 2020, right, when the S&P 500 made a new all-time high, this index made a lower high. So this is an index that I'm now paying very close attention to see if there are signaling properties to it. But very close to an inflection point, if we get back above those moving averages, that would be a sign that breadth is broadening out, right? Which would, in theory, help the top panel of this chart as we dig further on breadth. It's not great in the long term. And by in the long term, I mean, let's look at breadth from a trend perspective and say, what percentage of stocks in the S&P 500 are above their respective 200-day moving averages? And what I see is, as we close out the first half of the year, less than 40% of the stocks in the index are above their 200-day moving averages. Now, it's a little bit better on the intermediate term, as 63% of the stocks in the S&P 500 are above their respective 50-day moving averages, right? So intermediate term, okay, healthy majority. Longer term picture, not as great. And if we look at the advanced decline line at the bottom of the chart, you can see it's pretty much gone sideways with the market. So as we think about inflection points, if the market breaks 3250 to the upside, we want to see these breadth metrics improve. Right? Because if they do not improve, that would leave a divergence in play, and that would lead you to believe, or it should lead you to believe, that the potential is there for the break through 3250 to be false and quickly reverse itself, in which case you have to start thinking about being defensive in nature. Sentiment is mixed, and this is probably one of the more surprising indicators in the work that I've done here. The top of the chart is a 13-day moving average of the CBOE equity put call ratio. And why 13 days? Just no other reason than that's a Fibonacci number. But what's interesting to me is that recently the excess greed in the market was more pronounced than it was at the January and February highs for the S&P 500. All right, those January and February highs quickly reversed, and we saw excess fear in the marketplace heading into those March lows. And then all of a sudden that fear in the options market dissipated. And we actually took out the levels from January and February. And we still remain with excess greed in the marketplace. And there's a lot of kind of thoughts that I have about this. But what's interesting to me is it contrasts what you're seeing in the VIX, right? Where the VIX remains elevated. Right now, it's certainly come in. There's no two ways about it. We're not going to argue the fact that it's come in from the extremes of over 80, but the VIX is still hanging around 30. It's still hanging around the areas that have marked peaks over the past 5 years. So while options traders are excessively greedy and continuing to position for upside, the message from the volatility area of the market is still a little bit dicey, still a little bit more cautious in tone, if you will. So it's an interesting dynamic. I do think sentiment is mixed. I think positioning is starting to rectify itself, but I think speculators largely remain net short the market. So somebody's going to be right in a big way, and somebody's going to be wrong in a big way. Again, getting back to the concept of being at an inflection point. We're just going to watch price to help us determine it, right? We're very much trend focused, and we pay attention to the key trends in the markets and try to assess how likely they are to continue. Now, one thing that does jump out at me is that we are not exactly screaming risk on. And I like to take a market-based approach to measure risk on. And I look at an equally weighted version of consumer discretionary versus consumer staples. And what you can see is that for the better part of 2 years, the trend has been down. Now, the trend accelerated to the downside with the onset of COVID-19. We've quickly rallied back to a declining 200-day moving average and broken support and failed. Right. So if you think about consumer discretionary companies selling the products you want and the consumer staples companies selling the products you need, if we were really in a risk-taking type of mood, you would expect to see discretionary outperforming staples, and it has not been the case, and it has not been the case for 2 years, right? I'll actually argue that growth has been slowing for over 2 years, and we'll talk about that a little bit later on, and certain areas of the market have actually been in a bear market for 2 years. Not necessarily the Qs, not necessarily the S&P 500, but go back to that value line, right? And go back to the Russell. Those markets were sideways for the better part of 2 years. So it's an interesting dynamic at play. Notice the RSI at the bottom of this chart, though, breaking the uptrend line as well. I think we're likely to see discretionary continue to underperform staples as investors sidestep risk here in the near term. Now, let's get back to the view that drives a lot of my thinking. I do a lot of cross-asset work. And since I'm not an economist, I need market-based measures to kind of give me a clue as what's happening thematically in the economy and what that means for what's happening in the market, right? So I look at copper versus gold. Copper is an industrial metal widely used throughout the economy, globally actually. Gold, a precious metal, right? Widely turned to in times of uncertainty. And what you'll notice here is the peak was in late 2017, early 2018, and a downtrend began somewhere in the first half of 2018. So to me, this is a proxy for investor expectations of global growth, and it's been slowing for over 2 years. Now, what's interesting is in the fourth quarter of last year, this ratio tried to reverse itself, right? And then the red box on the chart speaks to that. And that largely coincided with better news around a US-China phase one trade deal that had investors anticipating an uptick in global growth. That quickly gave way at the start of the year, accelerated to the downside with COVID-19. So now we've seen a reflexive snapback type rally to the underside of broken support at the 2016 lows, while the ratio remains below a declining 200-day moving average. Notice the RSI in the middle of the chart has not become overbought on rally attempts, right? Didn't become overbought on the rally attempt in 4Q19, did not become overbought on the most recent rally attempt. Why do we care? Because as this ratio trends lower, interest rates stay pinned to the downside and potentially head lower as well. Now, at the last FOMC meeting, Chairman Powell told us that he is going to maintain essentially a zero interest rate policy through 2022, right? So obviously the chairman of the Federal Reserve doesn't see growth picking up anytime soon. So with growth continuing to slow, I would expect this ratio to continue to trend lower, which would keep rates pinned. Why do we care? Because it impacts certain areas of the equity market. I would expect growth to continue to outperform value in that environment, right? I would expect rate-sensitive areas of the market to be impacted, right? What does this mean for financials? What does this mean for REITs and utilities, right? So it all does come back to the equity market. And I think now more than ever, it makes sense to take an intermarket approach, to pay attention to what is going on in the commodity markets, to pay attention to what is going on in the fixed income markets. I think it's going to be really important going forward, right? Because here's your 10-year, right? If you're paying attention to the copper to gold ratio, which is now failing at resistance, you'd be keyed into the fact that the 10-year is falling from a consolidation, right? The 10-year yield went into a steep decline into the March lows with COVID, and then went into a triangle consolidation for you classical chart pattern folks, out of which we are now falling. The 10-year yield is falling out of the consolidation. It's really interesting because this kind of flies in the face of the rally in the equity market if all you do is look at the Qs in the S&P, right? If all you looked at was the Qs and the S&P 500, you'd say somebody has it wrong. Either the bond market has it wrong or the equity market has it wrong. But I don't think the bond market has it wrong. Right? Growth is slowing. But the Qs and the S&P are dominated by those monster mega cap growth tech companies and consumer tech companies. Go back to that value line geometric chart, the weekly chart. That's failing at a moving average, that's failing at a broken trend line. I think the bond market has it right, and it really depends on how you're positioned in the equity market as to whether or not you're going to outperform or if you're just going to muddle along, right? Another group that we like to look at here, banks versus utilities, right? And I like to see what that means, right? Banks, two interest rate sensitive areas of the market, banks and utilities. I think that if this ratio breaks down, it would confirm a breakdown in yields. The breakdown in yields that we're seeing would be confirmed here, right? And you'd want to be avoiding the banks relative to the utilities. right? And if that ratio, the KRE to XLU ratio, begins to break down, well, for the most part, on a 6-month time frame, that's a positive correlation to the S&P 500. So if we see a breakdown here in this ratio that confirms the breakdown in yield that we're seeing, we can start to think about the fact that the bond market has it right. We have to start to think about the fact that support is likely to give way in the S&P 500, right? Near term, rising trend line for the ratio to which price is very close, presenting another key inflection point that I think it's important to pay attention to going forward here. Commodities signaling inflation in the near term. I'm asking the question because I think that that would be a tough situation, because in theory, that would be stagflation. Little to no growth, as evidenced by that copper to gold ratio and as evidenced by what we're seeing in the fixed income market. But higher commodity prices, that's stagflation, right? No growth, rising inflation. So commodities kind of look interesting to me here. As near term, they are moving higher. We're above the 50-day moving average. We've broken topside through the 130 resistance zone, but still very much below a declining 200-day moving average. So while there is some room for further upside, especially if looked at in a longer term picture, I do think that this is simply counter trend in nature at this point. I think it's something that we need to start thinking about and kind of running the if-then scenarios, and that if commodities started to gain traction to the upside, what does that mean for equity markets, right? Because then all of a sudden you have to start thinking about hard assets, right? Like real estate. You have to start thinking about a big potential turnaround in the energy complex, right? So kind of playing this game in my head and running through the if-then scenarios while keeping, it's all about keeping an open mind, really, right? This trend is down. I believe it is down, but what if I'm wrong? What if this trend does reverse? Now think about the trend. It's been in place since 2008, right? This downtrend in commodities has been in place since 2008. If this reversed, it would be a big deal. This is a 12-year trend. To think that a 12-year trend would reverse and that wouldn't have wide-ranging implications for every investor would be crazy. So I think we want to start paying attention to what that means, right? In the near term, oil is at a critical level. I think it needs to, in order to think that that commodity story really is gaining traction, we're going to have to see oil meaningfully break above 40 and ideally get back above 60. Still very much in a downtrend, below the 200-day moving average, above the 50-day moving average. But if we look at the bottom of the chart, what you'll see is a MACD sell signal as oil gets back up to what was support once broken, now becomes resistance at that gap down from the February and March timeframe. So certainly at a critical level there. Gold can continue to shine, new highs for gold. Anybody who's been listening to my shows or reading my work for a long time knows that we have been and remain bullish on gold. I think gold is one of those, there's a lot of ways to win with gold from a trend perspective, and even depending on what happens from an economic standpoint going forward. I think the biggest risk to gold right now is that the trade appears to be getting crowded. So that's kind of interesting to me. But that trend is certainly up. I think we want to be on the right side of it. Gold now trading at its highest level since September 2011. And I think the dollar is going to be key to this whole commodity story. If we look at UUP, we can see it's trading below the moving averages, 50 and 200-day moving averages, but holding key support at $26. If the dollar breaks down, then you have to start to think about that trend in commodities really reversing higher, right? And then what are the implications on portfolios for that? And how do you want to be positioned should that start to play out? So far, support is holding. And I do still think that the path of least resistance from a longer term trend perspective is up for the dollar, right? But I have to start thinking about what if I'm wrong in that view. Below 26, I'd be wrong in that view, and we'd have to start thinking about a stagflationary type environment, right? So again, very much at an inflection point. So where is the leadership? Well, in a slow growth world, own growth. That has been our mantra for the better part of 16 months here at Chaikin Analytics, and you can see why. Take a look at that trend in the growth versus value dynamic, right? IUSG versus IUSV, a nice steady uptrend. And if we took this chart back 5 years, you'd see a nice steady uptrend. Now, do I necessarily want to chase it here? Probably not. Small negative divergence beginning to play out between the ratio and its RSI. But again, that widely lines up with Qs outperforming the SPY, which you can see at the bottom of the chart. And this even is being seen in small caps, right? I have not liked small caps. I told you that from the onset. But if I were to invest in small caps, if I were to look for opportunities in small caps, it would certainly be in the growth area of small caps, which we can see is steadily outperforming small cap value using the iShares Russell 2000 growth and value ETFs as a proxy. Again, growth over value, a theme that is in place and likely is to remain in place. And the fundamentals kind of paint that story as well. At Chaikin Analytics, we use our 20-factor model to rate over 4,000 stocks and over 500 ETFs, right? Largely with fundamental data. And what you'll see at the bottom of the screen is tech, comm services, and discretionary are more kind of growth sectors of the market, if you will, have very bullish and bullish ratings, where the more cyclical and value sectors of the market, like financials and energy, have bearish and very bearish ratings. So the fundamentals are lining up with what we're seeing from a technical picture, and that's usually a powerful combination, right? You can get a sense for the 20 factors that we use to rate stocks, right, within the financials, earnings, and expert buckets, and then the traditional kind of technical work that we bring to the table as well. And what's interesting is we can look at each of the sectors and say, well, how many stocks do we rate bullish, neutral, and bearish, and get a sense for, does the model line up with the trends that we're seeing in the market? And right now, that very much is the case, right? As we look at things like technology outperforming. Take a look at the scooter at the bottom, 96 scooter score for tech. That is growth, folks, and that is outperformance. How about discretionary? Scooter of 82. Now, this is just the straight discretionary ETF, right? So Amazon, a big weight there. But again, that's part of the growth story. What about comm services? Some event risk here with some people pulling advertising from social platforms, but still a nice steady outperformer trading close to a 52-week high, right? So you can see it is the growth areas of the market that are leading. Healthcare showing signs of a rebound on a relative basis. And this would be important for that growth over value story as well. Energy, I am not interested. I remain uninterested. Look at that scooter, 2.6 for XLE, which is mired in a secular downtrend. Now, with the dollar at an inflection point, with commodities at an inflection point, could this change? Of course. And would I change my tune? Of course. But mired in a downtrend. Financials, no thanks. Unless it's the growth area of financials, take a look at mobile payments. Take a look at that rising scooter, right? Materials are improving. That's somewhat interesting to me. And we are bullish and remain bullish on gold miners, right? We can screen for growth. We do this at Chaikin Analytics, just screening growth stocks for some key attributes. We find names like Adobe. We find names like Eli Lilly. We find names like Charles River Labs, right? These are the growth areas of the market. And if you're interested in seeing this screen and many of the others, feel free to jump over and take us for a test drive. www.chaikinanalytics.com/test drive. Free 14-day trial where you'll get my daily note, Mark Chaikin's weekly note, and be able to participate in the open forum calls that I host. I look forward to seeing you on one of those soon. Have a great day.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.